whoever the application is, whoever the company is that is owning that distribution, they're going to want to have their own stablecoin because that is the easiest way for them to potentially own how economics are distributed.
Circle seems like the easiest short here over a long time horizon.
I bet you Paolo cares more about Bitcoin than he does Tether itself.
Hi everyone, welcome to Unchained, your no-hype resource for all things crypto. I'm your host, Laura Shin. Today's episode is brought to you by Binance and Aptos. Binance is the world's #1 crypto exchange, trusted by over 290 million users. With industry-leading liquidity, security, and a wide range of digital asset products, Binance is the place to buy, sell, trade, and earn crypto. Download Binance today to get started. Aptos is the no-compromise infrastructure for global financial markets. Fast, reliable, and 100 times more cost-efficient than other blockchains. See for yourself why Aptos is the chain of choice for institutions, users, and developers alike at the Aptos Experience, October 15th and 16th in Brooklyn. Hey everyone, I'm here with Rob Hadick, General Partner at Dragonfly, and Mert Mumtaz, CEO of Helius. Welcome, Rob and Mert.
Hello.
Hey, Laura.
Today's topic is all these stablecoins and stablechains. And we're just, at the start of what looks like it's going to be some great stablecoin race. Obviously, Tether, Circle, and Athena have been sort of like the winners of the preliminaries, you could say. But after the passage of the Genius Act, the U.S.'s stablecoin law, it's pretty clear that now the real race is getting underway. We just saw Plasma just had its TGE to much fanfare. Stripe is getting a lot of buzz with its acquisitions, plus also its upcoming Tempo blockchain. Circle also just launched its own L1 ARC. And there's so many others in the works. I mean, I could list so many, and multiple of them have been mentioned already on the show before. But, on top of that, we are seeing now these ecosystem stablecoins. Obviously, USDH got a lot of media attention. And then, of course, we have had news like, apps like Phantom are also rolling their own. Jupiter just launched one using Athena's stablecoin as a service stack. So there was just so much news. We probably want to synthesize a lot of this. And Nick Carter started to do that with a great piece on X, in which he talked about how he had long thought there would be a small number of dominant chains or stablecoins, but now he thinks there will actually be many. And that will be driven by the fact that intermediaries will want that yield for themselves. So, Rob, why don't we start with you? When you look at all this activity, how do you think the competition will play out in the stablecoin space?
Yeah, I mean, I think I've long been a believer in a lot of what Nick put out in that piece, which is that if you follow the incentives, right? So I always think about the world based on what are people's incentives. And the incentives have been for a long period of time that people want to do a couple of things. They want to own the end customer, and they all want to own how economics are distributed, right? And in both of those cases, that means that whoever the application is, whoever the company is that is owning that distribution, they're going to want to have their own stablecoin because that is the easiest way for them to potentially own how economics are distributed. There's ways for them to do that with service providers, which is Athena specifically. Circle's doing a lot more rev share now than they used to. They obviously are a little bit more hampered because of that deal they have with Coinbase. They get 50% of the revenue to Coinbase. But there's also things like the consortium model with USDG, or then there's like white labeling with people like Agora or Paxos also does it, but Brit does it as well. And you start to look around and you say, okay, well, there's like this infrastructure in place that allows me to own more of the user experience, to own more of the end customer experience, to keep the economics for myself, to distribute the economics the way I want to, and then to create a product that is, is that tailor-made for what I think is the best for that person. And so I think like the reality is the vast majority of, call it consumer applications, tech companies, even people like a Walmart who has been trying to do financial services for years are likely to want to issue their own stable coins. That's probably the next, year or two at a minimum. Like we're probably in this, call it period of like unbundling. So I think about it a lot as like the fintech, like mid 2010s market where you took like a bank and then all of a sudden you had a fintech that did each part of what the bank does a little bit better. And so people started using them. And then I expect sometime in the future, there will be what I would call like a rebundling, which is that everyone realizes that this actually kind of sucks to have like all of these different tokens, even if they share liquidity. And I don't want to have to think about, what those, different integrations should be, like how I think about, putting connecting to different APIs. Like I don't want to have to think about all of the tickers alone. Like that's just a bad user experience. Having like USD, like we were literally debating on a Dragonfly call yesterday, like the difference between like a USTB versus USDTB versus like some other USTB, right? And then it was a portfolio company of ours that had issued one of them, right? Like these, like it's just not a good user experience. So I think it's going to continue to follow the rate of change here, where everyone wants to own those economics, and they don't believe they should be giving them to the stablecoin issuers themselves, at least in mass. And how that evolves over time is probably not that, but it's the current meta.
Well, wait, and I'm sorry. So when people reach that point of being like there are too many, you're saying it's not going to switch back to what it is now. But like, do you have a sense of what that will look like at that point?
What you'll probably end up having is either one of two things. You'll end up having some sort of like, call it like clearinghouse, the way we see, what happens in like traditional asset classes, right? Where fully shared liquidity across not just the, everything issued by Paxos, but everything issued by Paxos plus Agora plus M0 plus, XYZ, right? Where somebody's share is sort of a middle layer. I don't think that is the optimal outcome, frankly. But I think it is, people tend to, that's kind of how the legacy payment system got built, which is that you put a lot of like stopgaps on top of each other. Or I think what we'll also see is we'll see like a coalescing around like a few major brands, a few major stablecoins, a few major, kind of service providers, and there'll be like 5 or 7 that will like be of any real scale, and then everything else will maybe like more closed loop in the future. That's probably more of the optimal outcome than like some sort of clearinghouse, because frankly, like blockchains themselves should be a clearinghouse, not some sort of like intermediary.
Okay. And Mert, go ahead and give your vision for how this whole stablecoin competition will play out.
Well, for the last question of how this plays out, I do have a tweet on this actually. There was about a 2-week period where I felt inspired to make a bunch of shit posts around stables. And one of them was that I was using Backpack, the exchange, and I sent some stables on there to on-ramp, some fiat. And it then turned into USD. I believe I sent it USDT, but it turned to USD. I did the same thing with USDC, and then it turned to USD again. And so that is to say, they actually started abstracting all the tickers away and just said they got rid of all the last letters, and it was just USD. And then if I wanted to take it out, they would give me the option or give me like a default setting. And I think that's, if I'm an app and I don't have my own issued stable, let's say, then probably what I want to do is I want to let these stable issuers compete to give me the best yield. And the way I'm going to do that is to make them commodities. And the way I make them commodities is to abstract them away so that I can just fungibly swap them out. And like I'm getting some insight here from being an RPC provider where it's sort of a similar business where people can swap you out in some cases for another RPC. And when you have, so I think like the most interesting part of the Genius Act and the new regulation is that, there was 4 or 5 years ago, or really even 2 years ago, you would only use USDC, or I would at least, because I trusted it the most. And I was like, okay, well, Coinbase is not going to rug me, but I don't know about these other ones. But now if these guys are all regulated the same, I don't really care about that too much as long as I'm in the States at least, or I'm using one of these apps that I trust. And so I think the end game looks like the ticker is just being abstracted. And the technical work for that is actually not super difficult, depending on the architecture you're using. But you should be able to swap them out with between liquidity pools, like even today on Solana.
I do think like but the problem with that, Mert, a little bit is like people have tried to do that. Like they're Backpack's not the first one doing that. Managing the liquidity is annoying and costly, and it really depends on like how far you want to go, right? Like, okay, you do USDT versus USDC, like, that's probably fine, right? Nobody really wants to mint redeem directly with USDT, but you're like willing to take that, you're willing to keep enough USDT liquidity. But as we go down, like, if we get 50 of these, like they're not actually fungible, right? US dollars, they're like maybe the collateral is, but they're essentially like liabilities against, some other, kind of company or bank that exists. Right. And like they shouldn't because of that, they shouldn't actually trade 1-to-1. Right. So you end up getting like a lot more slippage or a lot more like theoretical, like, value like leakage, which is sort of why I think people just end up trying to create their own, and then having somebody else, even like, and somebody else incentivizes, or like an infrastructure provider incentivizes them to take their own and to do some sort of rev share, versus like actually like managing like liquidity pools for a bunch of like a long tail of tokens.
Yeah, I agree with that. The way I think of it is, and you can basically predict everything that I will say based on one concept, which is just a Pareto principle, which is to say there's probably going to be 3 or 4 of them that are just the biggest and win. And then of those, I think they will be interchangeable to some extent. Or I'm completely wrong. I'm honestly not necessarily... I obviously got jealous of what was happening on Hyperliquid, and I was like, how come these guys are getting everything back, and then we're just getting like wrecked here on Solana land? So I'm really curious to see how like Jupiter and the Phantom ones play out, because like the thesis is like, if you own a distribution, then you, in theory, own you have more bargaining power. So I want to see within the next few months if that actually makes a huge difference, or if like perp sexes, where like the stablecoins are actually a huge differentiator or a very important part, are actually like a special kind of a special case.
And wait, Mert, just to ask you a little bit more about that initial vision that you painted about how the end, because like, so another way that we could think about this, by the way, is just like, there's going to be some B2B sector, and then there's going to be like the retail side. So in the vision that you painted, it felt like you were just looking at it more from the retail side. But I wondered, on the back end, like, what did you think it looked like? What was it, that more like Hadicky version that Rob was talking about? Or did you have a vision of like, there's just going to be a few, and like basically, the companies that are abstracting this away will gravitate towards certain ones that, do X, Y, or Z? Or like, what were you thinking on the back end?
On the back end, well, I think you need just to accept a few things as truths and then reason up from them. One is that money is generally a network business. So network effects are going to win out for the larger players. This is why you see USDT raising an insane amount. I think, what was the valuation? Like 500 billion? Like, I don't even... It was crazy, right?
That's what they're saying.
Yeah. And like, the bigger you are, you don't get linearly more power, you get exponentially more, right? It's a network effect. And so I think that probably plays out for about 3 of them, 4 of them max. And maybe there's like geo-specific ones. For example, in Dubai, I went to try to pay for nicotine with USDC on Solana, and the guy was like, no, brother, no, I only take USDT on like Tron. And I was like, what? Like, why? It's like inferior in my view. But anyway, and so when you work up to there of it being a network business, then there's really going to be a Pareto distribution. And if that's the case, then you should be able to swap out the big ones, right? Like USDC to USDT today is not a hard conversion. And then maybe you add 2 more. And then, the principle of like, well, if it's the ideal UX for the user, that's probably where it iterates towards in the eventual endgame anyway. But like, the counter is that if you look at the financial system today, the amount of hops you need. So for example, I used to work at a fintech in Canada, and to send money to Australia from Canada, we had to use like AirWallex APIs and a bunch of other things. And the amount of hops the money took to get from Toronto to Australia was like insane and super nonsensical. It would just bounce towards all these different jurisdictions. And so there is a world in which actually the back end still sucks. Because the incentives of some of these middlemen are different in B2B. So I'm not an expert there. Rob would know much better than me.
Okay. Well, let's also talk about just the fact that we are looking at a playing field already, where there are certain chains or coins that have gotten in the arena and already have become dominant. So, just when you look at like where the various, like what features different chains are going for, what are some of the different advantages or disadvantages that you think will make or break the competition? Like, you talked about the network effect. So do you think that like Tether out of the gate is just going to, continue to dominate? Or like, what are some of the other things that you think, could change just the current rankings?
in terms of rankings, okay, well, I'll come at this from a left curve retail user, which is to say, today I have a good amount of cash, and I'm much more comfortable with USDC. However, I find myself keep swapping that into PYUSD, and the only reason is because Camino gives 12% on, and PayPal is paying me money to win this race. So I'm basically just trying to extract from whoever's going to give me the most money, because I'm okay with that risk of depositing in a lending pool. So I think USDT. So I think there's like a few different user classifications here. One is that the person who just doesn't care, they're not going to really, do borrow lend. They're not going to have any real size. They will just do whatever is the default, it seems to me, right? Like if Phantom is making you use their cash token, I'm probably just going to use that. I don't really care. Even within Cast, I don't necessarily care which is like the card company. I don't really care which one I'm using. They're all fungible to me. In DeFi, I use the one that gives me the most yield, provided it's not like a super sketchy one. It seems to me that the new wave is going to be, as Rob said, the people with the distribution, the Phantoms, the Jupiters of the world, releasing their own, but then working with one of these people, issuer types, behind the scenes. So like Phantom is working with Bridge and Stripe, and Jupiter's working with Athena, right? And so the apps combining with these infrastructure stable companies, and then whoever has the most distribution kind of dictates the rules.
So for Tether specifically, like if you were to go ask Palo today, like, why do people choose Tether, right? And why don't you share any yield? Like like people ask him this every panel he's ever on. And what he'll tell you is like, he doesn't need to, right? He has brand recognition. To Mert's point earlier, he went to go buy nicotine and the guy said, no, I only take Tether on Tron. Well, it's kind of a similar story across the global South. Like if you go to a corner store in, Argentina, they don't say, hey, listen, I want, a US dollar or I want stablecoin. They like, I want Tether, right? Or I want Tetra, right? Like that's what people say all the time. So there's this brand recognition that exists in a lot of the world, in the same way that like every time I call a Lyft, I still say I call an Uber, right? Because like I just think of cars coming to me as Ubers, right? That's what's happened. Does that have to persist forever? Like absolutely not. But it certainly is very hard to break that monopoly for a lot of these users in the global South, at least in the peer-to-peer transactions, right? The way it gets broken is if Nubank all of a sudden decides to only use Circle USDC, and Nubank has 40 million customers, and they start just using USDC on the back end, right? And so that is kind of the story that Mert's selling, and I think we all agree, which is that if you own distribution, you can theoretically swap people into something else. But a lot of the transactions today have either been for remittance, they've either been for peer-to-peer on the retail side, right? And so that happens. There is a brand that matters there. There's trust. I think you talk to people in the global South, and you talked about Circle, and like there is a perspective that like Circle is like Fed chain, right, or the Fed token, right? And they're like maybe it's more risky because like it actually did depeg in when there was the banking crisis, right? And in the US we have people like Mert who are sophisticated users, right? Like he's like, okay, I'm going to Camino, I get 12%, like that's really interesting for me for PYUSD. Nobody holding Tether in Argentina, I mean, maybe not nobody, but vast majority of them don't care about 12% on PYUSD. They may have never heard of Camino. They will probably never interact with Camino. Like that is not like the thing that they are doing with their stablecoins. And so what we've seen right now is there's this group of sophisticated users like Mert who do care about these incentives. And though we've seen a lot of growth for things like PYUSD and Solana because the power users like Mert care about those incentives. But when we think about like what is the opportunity for stablecoins to go from 300 billion to 3 trillion, like it's not the Merts of the world. It's people who like will maybe never interact with Camino, right? And so I think it's really hard to break that monopoly right now. I do expect though that there is a world where we see, I mean, the applications like the Phantoms, et cetera, where they're trying to put you into cash. I do expect there's a world where we see a lot more just USD balances on these fintechs to the getting all the way back to the backpack example that Mert gave, where everybody is saying, actually, this is just $1. And what's happening on the back end is that these people are mostly swapping to a token that shares economics with them, right? And that's how the liquidity is managed. And then the person who is actually managing all that liquidity is a Paxos or an Athena or an Agora or one of these white label firms, a Bridge, et cetera. That's the world where I see Tether losing market share. If we're in a world where we continue to say, I want USDC, I want USDT, I want USDE, that world is one where I think Tether just it can't be displaced, right? And so I think it really depends on how the end, kind of consumer apps decide to operate. I mean, that's really the consumer side. So we've talked a lot about consumer, right? And because consumer's been driving a lot of these prices. But if you think about B2B, it's a $200 trillion market. It's 10 times bigger than the consumer market, right? Right now, most of what we see in the B2B market is very much, quote unquote, like a stablecoin sandwich, or it's, there's fiat on the end. There's a lot of friction. Mert talked about Air Wallets, but, Jack Chong, the founder of Air Wallets, he's been, publicly very bearish on stablecoins because he'll continue to say, listen, you have to go into fiat at the end, and that actually has a lot of friction and it's high cost, et cetera. But what if there's a world in which you no longer have to do that? You can actually do treasury management at scale globally with stablecoins. You can actually do, maybe merchant settlement itself with stablecoins. You settle. I mean, there's already a card company, Rain, which is underneath Cast, which Mert uses, that settles with Visa in stablecoins, right? And then they settle through the acquirer to the merchant. If the merchant wants stablecoins, they can also take it, right? And so in that world, there is, I think, more value put on trust and counterparty risk and just name brand recognition for institutions that is different than the retail user, right? And the retail user definitely has more trust for Tether today than the institution does. The institutions, especially the large conglomerates, definitely are looking at things like, access to public markets, Circle being publicly traded, maybe size of the balance sheet, how transparent the balance sheet is, or do they have audits that, are verifiable? And in that world, Circle is probably winning today with that group of people. And it could theoretically, you could see displacement there, or maybe there would even be a JP Morgan token or, somebody like that, those large conglomerates would care about. So I think those are the ways that Tether gets, displaced. But, the market has to evolve from where it is today.
I have one, this just came to me. I don't know if it makes sense, but I think one thing that's interesting for the future is Forex. I don't really see anybody talk about this, convert. So the context is, I think yesterday or 2 days ago, I saw a graph of the ruble, the Russian ruble, being up 40% against US dollar. And then I was thinking, because, my girlfriend's Russian, and I'm like, maybe she should be buying me stuff here, right? This is pretty egregious 40% difference. And then I was like, there's actually no real way for me to convert between these two today. There's a euro coin by Circle and USDC. But what if, and I was just in Singapore, for example, and I was always trying to do the math between what is this conversion? How much am I going to get wrecked by the card people, et cetera? And I feel there is an interesting, if you make the assumption that the dollar keeps its relative decline, I wonder if there's a player that's more of a foreign currency that's not Tether that actually really ends up getting bigger as well. I think there's an interesting arbitrage there.
I mean, there's a lot of startups. I mean, I'm sure you've probably invested in some of them that are trying to call it ingrained FX and stablecoins, right? The problem has been that nobody actually, even today with the US dollar performing as poorly as it is, nobody seems to actually want to hold these other currencies, right? So what do we see happening in the euro stablecoin? The people who are actually holding it are people who otherwise are denominating their business or denominating their income in euros and who don't want to take the FX risk, right? But when we think about the global south, for most of them, their perspective is still US dollars matter more. There's more acceptance. There's, continue to be, it's just better risk. It's better counterparty risk. There's more places that they can use it. Most of e-commerce today globally still takes US dollars, even and doesn't take and then takes like some local currency, right? And so this goes into more like a geopolitical point, but like we're kind of in a currency cold war at the moment between China and the U.S. And I think the U.S., despite the devaluing of the dollar, which is, you can talk about a lot of things when it comes to like, the U.S. debt load, et cetera, but it still continues to be considered, I think, the strongest currency globally. And until that goes away, and I think that's like a generational thing and that takes time, I don't know why people will want to hold, whatever, the ruble, even when the ruble is up, because the ruble is a really tough example, obviously, considering, but, even, whatever, the RMB or like, something else. But I actually, this again goes back to like the consumer versus business point. The more business that is done on blockchain rails, the more business that is done in stablecoins, the more people will want to hold call it a different, currency, because like they don't want to take FX risk in their local business, right? And so 68% of global FX is done in US dollars and fiat, right? Today it's like 98% in stablecoins. Stablecoins is not going to be 98% in the future, but I also don't think it's going to be 68%. Right. So the question is like, where does it fall like in the middle of those two things?
Yeah, I almost feel like the answer to Mert's question is not like another currency, but frankly, more like Bitcoin or gold, because there's no like basically like when you're looking like just from a geopolitical lens, like nobody's going to want to put their savings in like something related to that the Chinese government can influence, right? Or like the Russian government. They like people would be more willing to do that with the US government than like pretty much any other country. Maybe you guys disagree, but that's just my perception. But it is true. Yeah. Okay. Like the US has its own issues. I say this as somebody who lives here and is like watching the dollar fall and just being like, oh my God. But the point is that, yeah, that's why I feel like it would be something that's like maybe just non-fiat related, more like a Bitcoin or gold, which is probably why we are seeing gold going to, new all-time highs, same with Bitcoin. But okay, we're straying a little bit from the stablecoin thing. So I actually want to just move us through like, so we have actually talked about Tether already, but I do want to just hone in a little bit more on that point about how they're not sharing the yield, at least so far, because it sort of feels like they can only do that so long. It feels like as soon as like consumers realize, oh, we can get a similar product and everybody's offering yield, like I feel like they're not going to be able to keep that up. Like maybe they could do it for another like 3 to 5-ish years or something, but at a certain point I feel like they won't be able to. And like their USDT is kind of like I don't even know what to call it, but it has like a special place in Plasma, which just launched. And that one, has this little neobank attached to it, Plasma One, which is offering, 10% plus yield. It's advertising on its website, 4% cash back when they use the Plasma One card, stuff like that. So it almost feels like a GBTC BTC ETF situation with Grayscale, where they kind of like have one product where they've got like consumer lock-in and they know that they can sort of milk it for all it's worth, but they are getting like another horse in the race. I don't know. This is my perception, but I'd be interested to hear, just how you think Tether will try to compete now that there's just going to be so many new competitors.
I don't know if they care that much, to be honest. You kind of look at like what Tether's doing, right? And they're very focused on owning the end distribution, right? So like Plasma One is part of that, right? But they've also invested in like 3 or 4 other chains, right? They invested in Rumble. I think, in Singapore, on the panel that I was on with Paolo, he specifically said they were going to distribute USAT through Rumble in the US, I believe. They, I've invested in a lot of other like types of companies, whether it's like compute or AI or, other things where they're, I think, going to try to denominate things in stables. I think they like strongly believe that like distribution is all that matters, and like yield itself on 3-4% doesn't matter. I mean, the yield you're talking about, Laura, like 10-ish% on Plasma, and this cash back, like that isn't Tether that is providing that yield. Like that is XPL tokens that are essentially incentivizing with emissions people to go and use Plasma specifically, right? And then the next Tether chain stable will probably do the same thing. And then the next, USDZ chain will probably do the same thing. And so it's good for Tether in so much as they can increase their distribution, but the fight that is happening there is actually for the end user from a Plasma specific point, right? So for Tether, theoretically, they don't care if Plasma beats Stable or Plasma beats Botanix or Plasma beats any of these other chains, as long as somebody who's using Tether actually wins, right? And from their perspective, I think they would believe that distribution is what matters most. I actually think, and I don't know, maybe Paolo will send me an angry Telegram message after this, but I think he mostly cares about long term. I bet you Paolo cares more about Bitcoin than he does Tether itself, right? I think that he would rather have Bitcoin win more than he would like to have Tether win. And so if there is a world in which he can incentivize that, I actually think that's where Tether would move, less around US dollar hegemony and I don't know, things that are that you hear other people in the US talk about. And Tether's not a US company, right? It's a US dollar denominated company, but it's not, I don't know if they have the goals of the US government and a lot of what we talk about here in the US in terms of stablecoins in mind when they think about going to market.
Mert, any thoughts?
On what's the specific question?
Well, basically, as we discussed, Tether is not sharing yield, and now there's going to be a lot of competitors that are. And I wondered, if you feel like they're going to change course, or just generally what would be the best avenues for them to compete going forward?
If I were them, I would not care too much, I don't think. And one of the reasons is what Rob said about, the random clerk in Argentina saying Tether instead of USDT or, USD, whatever, is actually a very vivid and correct example. And I just know this from my own dad. Because I'm from Turkey and people there are like this too. It's the familiarity aspect matters much more than earning yield on your money. Earning yield on your money is a very crypto native or a New Yorker kind of thing in my experience, which sounds ridiculous, but it's relatively true. And so if you can just be one of these companies that is the category defining name, so Kleenex for tissue, for example, is another one. That's an extremely difficult network effect network effect to beat. It's one of the 4 monopolistic advantages that Thiel talks about in his writing. Right. There's actual technological secret. There's distribution. There is, economies of scale. And then there's branding, which is the most elusive one. But once you have it, it's it doesn't really go away. It takes many, many years, or it requires an own goal. If Paolo does something absolutely absurd, like an FTX or SBF style, that's the only real shot that I can see of USDT not competing.
Yeah, they don't need to do that because. Go ahead.
Yeah, just to add one thing though, I do think the one existential risk for Tether is that they how has Tether gotten so big, right? It's mostly gotten big on the back of the exchanges, right? Everybody uses Tether for peer to peer, but also Tether is used for all basically centralized trading, and that's how really how it's proliferated, right? So USDC dominates DeFi. USDT dominates CeFi. And I guess there's a world which, we had, Binance USD for some period of time until the regulators killed it. But I guess there's a world in which those endpoints, which the exchanges themselves decided that, hey, listen, they looked at what happened at Hyperliquid and they got mad like Mert did as well and decide that they need, yield or they need something else. And they decide to change the way that they think about, utilizing USDT. That's probably the biggest existential risk for them right now.
All right. So in a moment, we're going to talk about the other incumbents, plus also the upstarts and the banks. But first, we're going to take a quick word from the sponsors who make the show possible. Binance is the world's #1 crypto exchange, trusted by over 290 million users globally. With world-class liquidity, security, and a wide portfolio of digital asset products, Binance makes crypto easy for everyone. Whether you're new to crypto or a professional, Binance offers a simple user experience. Learn with Binance Academy, browse hundreds of tokens, and track your portfolio on an easy-to-use dashboard. For experienced users, Binance Pro provides industry-leading services and bespoke trading products. With some of the lowest fees and deepest liquidity in the market, it's no wonder over 290 million users choose Binance for everything crypto. Buy, sell, trade, earn, live crypto. Download Binance today and begin your journey into the future of finance. Disclaimer: Binance is not available in certain countries, including the US. Check its terms for more information. Binance.com/en/terms. Over 3.4 billion transactions processed without disruption. More than $1 billion in stablecoins circulating. Over $720 million in real-world assets tokenized on-chain. All delivered with sub-second finality, block times under 100 milliseconds, and fees less than 1/10 of a cent, making Aptos more than 100 times cheaper than other leading blockchains. Built by the team behind the DM project at Meta, Aptos is what blockchain performance looks like when it's built for global financial markets. Discover why global institutions like BlackRock, Franklin Templeton, and NBC Universal are building on Aptos, and see for yourself at the Aptos Experience, October 15th to 16th in Brooklyn. Back to my conversation with Rob and Mert. All right, so the other big incumbent that we need to talk about is Circle. I have a feeling you guys aren't going to say the same things about Circle that you said about Tether, but I would be interested to hear, especially now that they have launched their new blockchain Arc, how you think they can compete in this new world.
So, well, I have a lot of thoughts on the payments chains, but yeah, certainly I don't have the same views as Circle as I do Tether. I would say, by the way, that chain is not live yet, as far as I know.
I thought it had live. No, okay,
No,
sorry.
yeah.
Thanks
No,
for correcting
probably
me.
Q1, I think. Yeah.
Oh, okay.
Yeah. You know what? I'll let Rob go first here because I get pretty feisty when it comes to chains.
Well, I mean, she was asking more about Circle specifically, and then we can talk about the chains. Listen, I think on Circle specifically, like their position is definitely more tenuous, right? So being the first publicly traded, kind of call it stablecoin company, kind of positioning themselves as the regulated stablecoin company here in the US, something that's more fit for businesses. I mean, even Mert said that he trusted Circle more, which actually surprised me. Like that is been an advantage for them to date, but I also think it's probably an area of attack for them going forward because they're obviously going to lose that, that battle if like JP Morgan decides to issue their own, right? And like they're going after a market where they are, they're the second biggest player globally. They don't have the economies of scale that Tether has. They have an advantage based on, trust, based on the way that Tether has interacted, with previously and how they thought about some of their, their audits and their collateral usage, et cetera, with certain types of players. But they're going after a market that like kind of everybody else is going after, right? When I see new deals for like new stablecoin issuers, they're either going after like really niche like affinity groups, or they're going today after what everyone sees as the really big prize, which is like, B2B payments and like regulated payments and like, call it like very big, addressable markets. And that's the one that Circle's playing in. And so they need to scale as quick as possible. I think they know they need to scale as quick as possible, but I also think they know that they need to like not just be a stablecoin issuer, right? That's why they launched Arc. That's why they launched Circle Payment Network. That's why they continue to hear, I think when you listen to Heath and Jeremy talk about, they talk about internet money, but a lot of what they talk about right now is related to like how they can think about, specifically money movement, right? So it's about what can we build around money movement? How can we build? I think they see themselves as, someday competitive against Bridge and Stripe, not just competitive against, Tether, right? I think that's where the North Star is. And so, listen, I think for them, and that's part of the reason we've seen them decide pretty recently to not only are they sharing the 50% of yield with Coinbase that they've had since the beginning, but now they're kind of sharing yield with everybody, right? Like they paid Binance to put USDC in there. They're paying like a lot of startups to the yield on the USDC. And, over time, I don't know exactly where it ends up, But based on what I'm seeing, like my guess is that their gross revenue to net revenue, margin ends up being only like 20%, right? Like they share 80% plus of that yield, which is an entirely different model from Tether. And I think, belies how they're thinking about, what the future of the business is going to be, and especially as they continue to talk about payments. And so that's why they launched ARK, right? As I think they see ARK as a way to figure out ways to monetize and own the end customer better. Whether or not that's going to work, and whether or not they're best positioned to be launching their own blockchain, I think is a story that maybe I'll let Mert comment on first. But that's I do think like it's very clear that's a lot more of a tenuous position for them than it is for somebody like a Tether.
Yeah, just one comment before Mert speaks, which is that watching kind of their strategy and just like the positioning, it makes me feel like it's sort of similar to the ETF world, where just like everything kind of gets compressed down because it's so competitive. So that it feels like their strategy is in that world. But anyway, go ahead, Mert.
Well, I have nothing too interesting to add. I believe I agree with basically everything Rob said there. I was going to put it a bit more aggressively in that I think they know they're in trouble, which is why they need to launch this chain. I do think there's many ways to get out of being in trouble, by the way. I think they're competent. They've obviously shown they can execute and all these things. But I think they are... I was talking to one of my trader friends who's a pretty big crypto Twitter personality, and we were talking about like the next trades and stuff. And I was like, Circle seems like the easiest short here over a long time horizon. And not that I would short it. I'm not going to short. I don't really short anything, but that was like my sentiment, which is to say like that's just a very difficult position. And I really don't think these payments companies, especially Circle, understand the amount of disease you're going to get by building your own chain. Like it's way harder than you think it is, at least to win, right? You can obviously launch a chain and have it do nothing, which people have certainly exploited in the past few years. But I think if they want to actually compete as the top two, top three, I think the chain is not going to cut it. And, they need to, like, if I were them, I'm just thinking this through. It's interesting because, so I used to work at Coinbase, and I trusted USDC much more than I did USDT, which does not seem to be a very common position. And I was much more familiar with it. So I do wonder if there's more of a, like, this is more of an American coin, or like there's the trust from the Western types for USDC as opposed to the USDT. Now, of course, now they have Bo Hines and everything, and USDT is also becoming more American, so to say. But I would say like that's probably an interesting edge that I would consider if I were them. But other than that, I think Tether is doing roughly everything better. Looking at it from like a CEO perspective, I am jealous of how Paulo is running his business. And if I were him, I'd be like, yeah, this is going well.
I think on the chain side, maybe we should dive like a little bit more deeply in there, because I think Mert said something that was important, which is that like it's actually really easy to launch a chain today, like easier than it's ever been. It's hard to win, right? And that's why I think it's so tempting for all of these people, right, to launch new blockchains. There's kind of this weird middle ground that's happening right now, though, where people are like, okay, well, I'm going to launch a general purpose blockchain, and I'm telling everyone that I want all of these developers to come and build whatever they want, and I'm not going to have permission validators, and I'm not going to, require certain types of people to be on my chain or act a certain way. But also, it's going to be purpose built for this like B2B, use case, right? That is like, going to be regulated, et cetera. And that doesn't really make any sense to me. You kind of have to do one or the other, which is you need to either be more opinionated or just not opinionated, right? Like Solana's basically decided, hey, we're not going to be opinionated, and we're going to decide that we're, a fast chain that, has ability to do kind of like all of like major financial use cases, and we'll let you do whatever you want, right? Essentially. Or you have, something that's saying like, I am very opinionated about the fact that my customers that I already own should be doing this exact thing on this chain. And I will do everything in my power to make this product and this chain allow for that type of transaction to proliferate, right? And if you're somewhere in between those two, I don't really know what advantage you have, right? And I sort of feel like the language out of ARK and increasingly out of tempo as kind of I think Stripe has kind of stepped back and tried to distance themselves from it a little bit, is a little it's a little odd because it seems to be trying to appease the crypto natives who are like, we hate this like centralized, like Fed chain or whatever. At the same time, while trying to say that they're going to go and win some new market with a fully integrated product set that is enhanced by owning their own chain. So it's that's what I find weird, to be honest.
Like basically, you don't feel like they have a natural audience or market to go after at the moment. It's sort of like they've launched this chain.
You just either need to be really opinionated or not opinionated. And being like a little bit opinionated is like the absolute worst place to be.
And is a little, by that you mean like it's a payments chain, so it's not like a general purpose blockchain. But then like what do you mean by a little opinionated?
Yeah, like if you look at their docs now, right? Like they're like, okay, we're not general purpose, we're purpose built for like financial use cases, right? Okay, great. So I'm purpose built for I own some end customer, and I'm purpose built for payments. And what does that actually mean? I have enshrined FX. I have the ability to pay gas in my stable coin. I have kind of this ability to potentially do like opt-in privacy. I have et cetera, right? Like, and I'm going to build everything for my chain, and I'm same way I do my data indexing, and the way I'm allowing you to do reconciliation. Like, it is everything I'm doing is going to be built for like a payments company, right? Okay, that makes sense. Like you're building a payments company that is enhanced by blockchain, and the blockchain that you are building is enhancing the way that you align economics and you align your product, right? But then if you come out to the market and you say, I'm general purpose chain, this is crypto native, but also like, I want you to know that like, it's really good for payments and you should use this for payments, but also you can build pump.fun on my chain and you can launch a bunch of runners. Well, like that doesn't really work, right? Like you have to either be like unopinionated and let, pump.fun guys do whatever they want on your chain and everything else do what they want on your chain. I mean, Solana has X stocks and they also have pump.fun and they also have like, a decentralized version of OnlyFans, right? Like nobody cares what happens on Solana. It does all of these things, right? Or you have like a payments company that uses a blockchain. If you're a general purpose chain that is like kind of in the middle, you sort of end up like Stellar, to be honest, right? And people forget that, but Stellar was the first blockchain that Stripe invested in. Stripe was the seed investor in Stellar. Like it was supposed to be the payments chain, right? And so I don't. That's what I find really odd about the current iteration of a lot of these, call it these stablecoin chains, and I find him like I just find it to be that people are trying to appease a lot of people, and anytime you're trying to please a lot of people, you probably end up pleasing none, to be honest.
And so this maybe is a stupid question, but in that sense, perhaps it's a good question. Obviously, you guys probably know right now there's like a civil war or maybe I shouldn't call it a civil war, but there's a disagreement in Bitcoin about, the ordinals and meme coins, like all that activity. And, some people like they want to filter that out. And so like in this world, how is it that they can restrict the usage to payments or like stable coins? Like, is it, I actually don't really know what the answer is to that.
Yeah, so I have a post on this. There's really three ways. One is you do it. So Stellar is actually a good example. One is that you make the chain non-Turing complete, meaning, the reason Ethereum exists is because Vitalik said, what if you made this chain programmable, right? What if you could do more general things than just send and receive Bitcoin? And that's how you got smart contracts, and that's Turing complete. So one thing you can do is just actually make it like Stellar, which is basically Bitcoin, but only for payments. I'm exaggerating a little bit. They have added functionality since then, but that was like a low resolution idea of how that works, right? So basically make it such that you literally physically cannot do these things, okay? That's one way, and we know that way is probably not going to work. I mean, it could still, but like Stellar didn't do great, right? And that was Stripe backed. MoneyGram, for example, uses it, although I'm not sure if they will going forward, right? So the second one is permissioning the block space, right? Like where you literally have validators who who sign certain agreements or whatnot, who say, well, we're only going to allow such and such activity. These are the only things you can deploy on here, right? So it's at that point, I still don't quite understand why you're using a blockchain, to be completely honest. Perhaps for transparency reasons or something, because you can, I guess, verify it, but you can't necessarily do anything about it. But that's another way. I think that way is certainly not going to work. It's like a slight iteration on Swift. So like it could work, I guess. I don't know how the Europeans think, to be honest, but that's one way. And a third way is, I think, the much more interesting way, which is what Tempo is going to do. So Tempo is going to launch permissioned. However, I was talking to Dan Robinson from Paradigm about this, and they are actually going to add specific sequencing rules to the block space. So one example today is Hyperliquid, where in Hyperliquid, one of the reasons why it works well for perps, not the only one, but one of the ones, is because as a market maker, your cancels get prioritized over the takers. Meaning, if you have stale quotes, you have the priority in basically not losing money. And so that means more market makers come to the chain, better liquidity, such and such. With payments, you can do something similar, which is to say you can have specific block space rules to say, we're going to preserve 90% of the block space for these payments use cases. There's like interesting MEV around that, I think, that is going to be quite difficult. And this is actually why I said I think it makes much more sense to do as an L2 instead of an L1, which people are like, oh, Mert said L2. But like it's the obvious solution, right? Because with an L1 is just an L2 where you have a bunch of different leaders. So every time there's a new block leader on the L1, they have the option to not obey the sequencing rule. Which is why on Solana, for example, we're adding something called multiple concurrent leaders, so you can pick between the ones that actually produce the correct rules or something. So now I think what's going to happen, though, with the third approach, which is the Paradigm and Stripe one, is people are going to game it such that, like, let's play this out, right? Imagine that Stripe's chain succeeds, Tempo succeeds, and there's a lot of liquidity on it. Okay, so now that there's a lot of money on it, you will attract the mercenary types, the traders, all these different things, and they'll want to start doing something with that money. And there's going to be ways to then game that block space, similar to ordinals with Bitcoin, such that it's not actually prioritizing payments, but like maybe the payments is actually like a weirdly encoded version of a trade, right? Like it's going to be a game of cat and mouse and MEV. And then you're going to descend into the MEV chaotic world of crypto native stuff. So that's why I think they're relatively futile unless they're an L2, where you can actually have some consistent enforcement by a trusted party.
I don't know if there's any last words you guys just want to say about stablecoins, because one big topic we didn't touch on was banks. There is some reporting that like they might kind of band together to launch a stablecoin. But I don't know if you just want to leave us with anything about like how this competition will play out in the broader world.
Listen, on the bank consortium side, a lot of good businesses have been launched out of bank consortiums, right? That's essentially what Visa and MasterCard are. There's things like Synchrony and Symphony and other things that have launched that way. I'm probably pretty bearish on it happening on stablecoins specifically because there's like a bit of I think there's like misaligned incentives, right? In terms of why they would want to have a shared stablecoin, because then essentially you're really just becoming like the central bank in that case, if you're doing so, like a bunch of GSIBs. And then we basically have a CBDC, and then I don't know if it really ends up working in a way that is what people are looking for. So all of that said, we'll see. I don't know if the banks will be successful in trying to repeal this quote unquote yield loophole they keep talking about in the bank lobby in terms of sharing rewards. I would expect no, to be honest, because it wasn't like this is a new topic, right? Like everyone knew that it was a loophole when Circle was paying Coinbase and Coinbase was paying its end users. But we'll see. That said, listen, I know a lot of the people at these banks that are working on stablecoins. Basically, every single one of them is leaving the bank, right? Like all of them have looked around and are like, holy they're like crap. Like I can go make money in crypto. And I've got this job as like a mid-level manager doing like something that actually nobody really cares about at this bank, that makes no money. Like they're all going to leave, and that'll slow them down. And so but my perspective is that anytime that people tell me that a bank is going to win at something, they just haven't spent enough time working with banks.
Okay. And Mert, go ahead and leave your last thoughts and then we'll wrap.
Yeah, I mean, I worked at 3 of the large 5 banks in Canada, which is basically an oligopoly of the incompetent. And they are super antiquated. And I actually made a tweet 2 days ago, basically saying exactly what Rob said, which is if you're working at a bank, you should quit like ASAP and come join crypto. It's just like it's time for finance to enter the internet era, right? Like it's taken this long. And then the one thing I'll say in terms of fear mongering, to lead this off with, is you should be very scared of stablecoin stuff that doesn't consider privacy in any way. I would really encourage people to be a little more cognizant of that.
And I know that you're part of this like Zcash renaissance, we can call it. Is that your veiled attempt to promote Zcash?
Hey, I didn't say it. I just said privacy.
Okay. Okay.
Yeah, you can use. I mean, there's a bunch of other things. Even ARC, it seems like they have some privacy option. Just privacy over no privacy I'll live with that.
Yeah. Well, I agree with that. All right, you guys, this is super fun. Rob, thanks for hanging out a little bit of extra time. And yeah, we will catch you all later. Sayonara.